Investment. When we look at the current state of the economy, one word comes to mind: pressure. Inflation isn't just a number on a report, it's the very real impact you feel at the grocery store, at the gas pump, and even in the value of your paycheck. Every year, the cost of living creeps higher, and while wages struggle to keep up, the government faces its own challenge: an ever-growing mountain of debt. Traditional approaches like raising interest rates or printing more money, investment, have their limits. They only go so far, and sometimes they make the problem worse. That's why this new strategy involving cryptocurrencies is getting attention. Bitcoin and other digital assets have long been criticized for their volatility, but they also have unique properties that make them attractive as a hedge against inflation. Unlike the dollar, whose supply can expand at the whim of the Federal Reserve, cryptocurrencies like Bitcoin have a fixed supply. This scarcity creates an opportunity to preserve value in a world where fiat money continues to lose purchasing power. Imagine holding an asset that isn't tied directly to government policies or inflation metrics. It's a radical shift from the old financial rules. Trump's move to integrate crypto into debt management is a bold and unconventional play. Instead of relying solely on traditional bonds or treasury instruments, this approach considers the potential of digital currencies to offset part of the national debt. It's not just about diversification, it's about thinking outside the box. The strategy essentially positions the government to benefit from assets that could appreciate in value over time, potentially reducing debt obligations in real terms. This is a clear attempt to merge fiscal responsibility with innovative financial tools. Of course, no strategy comes without risk. Cryptocurrencies are notoriously volatile, and while they could provide a buffer against inflation, they could also introduce instability if not carefully managed. There's a learning curve here, not just for policymakers, but for the public too. Americans are being asked to reconsider what money really means and how it interacts with national debt. The success of such a strategy depends on careful regulation, public confidence, and strategic timing. In the end, this approach challenges the status quo. It's a reminder that solving America's debt crisis may not come from conventional methods alone. By exploring cryptocurrencies as a tool against inflation and as a potential debt management asset, the government is signaling a willingness to innovate. Whether it succeeds or stumbles, one thing is clear: the conversation around money, debt, and the future of finance in America is changing, and rapidly. Right now, inflation is one of the most pressing issues in the United States, and its effects are visible in everyday life. When prices rise, it isn't just numbers in an economic report. It directly affects how people live, what they can afford, and how they plan for the future. Groceries, rent, gas, and even utilities are all impacted, and the rate at which money loses value often outpaces wage growth. This creates a situation where families feel stretched, and saving becomes increasingly difficult. Traditional methods of managing inflation, like adjusting interest rates, only provide temporary relief and sometimes exacerbate problems in other areas of the economy. Higher interest rates, for instance, can slow down investment, limit borrowing, and reduce overall economic growth. At the same time, keeping rates too low allows inflation to run unchecked, eroding the real value of money over time. Inflation also has far-reaching effects on the government itself. The national debt, already at record levels, becomes more complicated to manage when inflation spikes. When the dollar loses purchasing power, interest payments on that debt can become more burdensome, and the government may find itself needing to allocate more resources simply to service existing obligations. This can crowd out other essential spending, and from infrastructure projects to social programs, creating tough choices for policymakers. Moreover, inflation affects investor confidence. When returns on traditional assets such as bonds are outpaced by rising prices, investors begin to reconsider where they place their capital. This uncertainty can lead to volatility in financial markets, which in turn impacts retirement accounts, savings plans, and business investments. Citizens often feel inflation more acutely than policymakers because it directly affects their day-to-day choices. Simple decisions, whether to buy a car now or wait, whether to invest in the stock market or hold cash, how to budget for the next month, are influenced by the rising cost of goods and services. These pressures can shape behavior in ways that further ripple through the economy. People may cut back on discretionary spending, delay major purchases, investment, or seek alternative stores of value. The cumulative effect of these individual choices can slow economic growth, reduce consumption, and shift the overall economic landscape. In this environment, traditional strategies alone are often insufficient. The Federal Reserve and other policymakers can attempt to curb inflation with monetary tools, but these approaches may be slow to show results and can sometimes create unintended consequences. The need for innovative solutions becomes clear, particularly when inflation begins to threaten both the economic stability of households and the structural health of the nation's finances. Recognizing the limits of conventional approaches is the first step toward exploring alternative strategies. These alternatives, whether in technology, investment, or financial instruments, aim to protect value, maintain stability, and give both the government and everyday Americans tools to navigate a challenging economic environment. Cryptocurrencies have emerged as one of the most debated financial innovations of the past decade investment, and their role in the conversation around inflation is becoming increasingly important. Traditional money, like the US dollar, can be printed in unlimited quantities at the discretion of central banks. Investment, which means its value can erode when more supply is introduced into the economy. By contrast, cryptocurrencies such as Bitcoin operate on fixed supply models, with Bitcoin capped at 21 million coins. This limited supply creates a sense of digital scarcity that mimics the qualities of precious metals like gold. As inflation rises and the dollar weakens, many investors turn to these assets as a hedge to protect their wealth from being eaten away by higher prices. The idea is straightforward: if the dollar buys less tomorrow than it does today, assets that retain or increase their value become more appealing. For the government, the potential role of cryptocurrency extends beyond individual investors' attempts to safeguard their purchasing power. In the context of the national debt, cryptocurrencies could represent an unconventional but meaningful tool. If the government holds assets that appreciate in value over time, it could offset some of the impact of inflation and reduce the real burden of debt. For example, if the dollar continues to lose value but Bitcoin appreciates due to its scarcity, a portion of government reserves held in such assets might strengthen the balance sheet rather than weaken it. This is a striking contrast to holding only dollars, in which steadily lose purchasing power in inflationary environments. Another aspect of cryptocurrencies' appeal is decentralization. Unlike traditional currencies managed by central authorities, digital assets operate on networks maintained by participants across the globe. This decentralization makes them less susceptible to direct manipulation by policymakers or central banks. For many, this independence is a safeguard against reckless monetary policies that contribute to inflation. If the government integrates cryptocurrency into its strategy, it could signal to citizens and investors alike that it is willing to consider alternatives beyond conventional levers of power. This willingness to diversify could improve confidence both at home and internationally, especially among creditors who worry about the stability of U.S. fiscal policy. However, it is not simply about storing value, it is also about trust. A growing number of people believe digital currencies are a fairer system because no single entity can inflate or devalue them at will. That trust can attract both domestic and foreign investment, helping to stabilize markets and encourage innovation in financial systems. The credibility gained from adopting assets with transparent, predictable rules could be a valuable counterbalance to skepticism about government spending and borrowing. Still, adopting cryptocurrency as a hedge or debt management tool requires careful planning. The volatility of digital assets cannot be ignored, and while they may provide protection against inflation, they can also swing sharply in price. Yet even with these risks, the conversation highlights a critical point. In a world where inflation chips away at value, cryptocurrencies offer a new kind of insurance. Their scarcity, independence, and growing acceptance make them a potential cornerstone in the fight to protect wealth and address the challenges of rising debt. And Trump's proposal to bring cryptocurrencies into the broader strategy for managing the nation's debt represents a departure from the traditional playbook that has defined U.S. fiscal policy for decades. Instead of leaning exclusively on treasury bonds, interest rate adjustments, or new tax measures, this approach seeks to merge traditional economics with emerging digital assets. At its core, investment. If the plan reflects a recognition that conventional methods have not been enough to keep pace with the growing debt and persistent inflation. By introducing a digital element into national reserves or debt repayment strategies, the idea is to create a new avenue of value growth that is not directly tied to the weakening dollar. This kind of thinking pushes boundaries and appeals to those who believe innovation is the only way forward when old systems continue to strain under modern economic pressures. The most compelling part of this strategy lies in its potential for appreciation. Traditional reserves like gold are known for their stability, but cryptocurrencies add a dimension of growth potential. If Bitcoin or other major digital currencies rise in value, the government could leverage that appreciation to reduce the effective weight of its debt. Imagine a scenario where a portion of debt is backed by assets that outperform inflation consistently. Suddenly, the burden looks less daunting, and the country gains breathing room to redirect resources elsewhere. Investment. This is not about abandoning tried and true assets, but about creating a hybrid model where innovation complements tradition. Such a blend could become a symbol of adaptability, showing that the U.S. is willing to evolve rather than cling to outdated systems. The symbolic value of this move also cannot be overstated. For decades, U.S. financial leadership has been built on the strength of the dollar and the perception that America has the most secure and reliable financial system in the world. By embracing digital assets, Trump's proposal signals to both citizens and international partners that the U.S. is prepared to lead in the future of money, not just in the legacy systems of the past. This could attract investment, encourage private sector innovation, and place the country at the forefront of global financial evolution. Such a bold step would also resonate with younger generations who already see cryptocurrency as more trustworthy than institutions they believe have failed them repeatedly. Of course, the success of this approach depends heavily on execution. Proper regulation, oversight, and gradual integration are crucial to prevent instability. Moving too aggressively could create unnecessary risk investment, while moving too slowly could mean missing opportunities. Balance is key, and the proposal emphasizes that strategic adoption matters more than symbolic gestures. A cautious yet forward-looking embrace of cryptocurrency could serve as both a safety net against inflation and a growth mechanism for national wealth. It is this dual potential, protection and opportunity, that makes the plan intriguing. At a time when debt feels overwhelming and inflation remains stubborn, the willingness to consider bold alternatives might be the spark needed to shift momentum toward a more stable and promising financial future. The conversation around adopting cryptocurrency as part of a national debt strategy is not complete without examining the risks and potential consequences. Digital assets may offer an exciting path forward, but their volatility poses a serious challenge. Unlike traditional assets such as gold or bonds, cryptocurrencies can experience massive price swings within days or even hours. This unpredictability means that while they could serve as a hedge against inflation, they could also expose the government to sudden losses if the market turns sharply downward. For ordinary citizens, this volatility could be unsettling, as the security of the nation's finances is tied in part to a market that has not yet proven long-term stability on a sovereign scale. Trust is fragile, and if a sudden crash were to occur, confidence in both the strategy and the government's financial stewardship could erode quickly. Regulation also remains a major question. Cryptocurrencies operate across decentralized networks, often outside the direct control of governments and central banks. Integrating them into national reserves or debt repayment strategies requires establishing clear frameworks for regulation, taxation, and transparency. Without strict oversight, the risks of fraud, manipulation, or technological vulnerabilities could undermine the benefits. Policymakers would need to strike a balance between encouraging innovation and ensuring that the system remains secure and trustworthy. This process is not simple, and any misstep could fuel skepticism from international markets or domestic investors who already view the national debt as a red flag. Another layer of complexity comes from public perception. While more people are becoming comfortable with the idea of digital assets, many still see them as speculative or risky. Convincing the public that their government is making a responsible move by tying part of the country's financial health to cryptocurrency will not be easy. Education and transparency are essential in this regard. If citizens understand that crypto is being used strategically alongside traditional tools rather than replacing them, confidence may grow. Without clear communication, however, fear and misunderstanding could dominate the narrative, reducing the effectiveness of the policy. On the other hand, the rewards of successfully integrating cryptocurrency could be transformative. If managed well, this move could position the United States as a pioneer in financial innovation, attracting international investment, and strengthening the nation's role as a leader in global markets. The government could potentially reduce the real weight of its debt, protect reserves against inflation, investment, and encourage private sector growth in blockchain and related technologies. This ripple effect could extend into job creation, new industries, and broader economic resilience. Ultimately, the decision to involve cryptocurrency in national debt management is a gamble, one with both risks and rewards of historic proportions. If successful, it could reshape the way governments around the world approach inflation and debt. If it fails, it could deepen existing financial challenges and shake global confidence in the U.S. economy. The outcome depends entirely on careful planning, timing, and the willingness to manage risk as diligently as the rewards are pursued.